Thanks a lot, Danny. It's good to be back for this session. So as she said, we're going to be talking about ethical investing today, talking about some of its evolution, the interest in it, but also how we might be on the cusp of starting to see a real change in terms of assets and flows towards ethical investing after lots of talking about it. So ethical investing actually stems back very far to the 18th century when Quakers used to restrict what their members could invest in. And so we've come a long way from that point to today, and I think we all feel like there's been a lot of talk about ethical investing, particularly over the past couple of years. But the big thing that's been missing is massive flows going into those investments. We have done some research at Agmel and lots of other places have. So Morgan Stanley did a survey and talked about the fact that 3/4 of investors are interested in sustainable investing, and that rises to a much higher number when you look at younger people, which generally broadly tracks the trends that we see in wider society in terms of people that are interested in living more environmentally friendly, maybe switching to veganism and having more of that focus in their life. But if we look, only 2/5 of people have actually switched some of their money to sustainable investing. And when we look at that, it's likely that some of that might be just small parts of their portfolio rather than them switching 100% of their assets towards ethical investing. But as we'll touch on later, we're starting to see a real pickup in those assets coming in. So Agmel did some research in this, and it broadly shows what I think a lot of people would expect, which is that younger people are more interested in ethical investing and they think it's important for their money. And also the females are more interested in ethical investing than men. So when we look across all age groups here, right from the youngest up to traditionalists, which is those that are older than baby boomers, women are much more interested in ethical investing than men. But the group that are most interested are millennial females. The thing that we've always thought of before is that while millennials and younger people are interested in ethical investing, they don't always have the largest amount of assets to invest. So they might be interested, but it's not causing a big swing in assets. But what we're seeing now is that millennial group, while we tend to think of them as being a very young group, there's people in that millennial category that are now in their early 40s and late 30s. So they will have amassed more wealth, they'll have amassed more assets, they'll be investing more, and that means that they'll likely be starting to see this switch in assets towards ethical investing. And we specifically also looked at pension investors. So almost half of our customers plan to invest more of their pension in companies with a positive environmental impact this year. And so if we think about the total volume of assets that there are in pension savings across the UK, and then we think even if these half people only put a tiny portion of their portfolio into ethical funds and investing more ethically, that has a real ability to swing the pendulum of assets towards more ethical investing, which means in turn that we as investors will then be rewarding and investing in companies that are more environmentally focused, have stronger governance policies, are really focused on benefiting society as well. And that can have a real impact for change across the world. So one thing that always comes up when we talk about ethical investing is the fact that lots of people, lots of investors think that they have to accept a lower rate of return in return for investing ethically. And our survey showed that that is still a prevalent view. So 1 in 3 people, a third of people, think that if they're going to invest to a more socially focused way, they will have to accept lower investment returns. And more men think this than women. What's interesting is, of those people, there was still a large chunk was still willing to invest ethically, but even though they were going to be accepting lower investment returns. And we'll look at some research and some data later that shows that that isn't the case, that people don't have to sacrifice returns always. It obviously depends a lot on the market environment at the time. But it shows that people don't have to accept lower returns for investing ethically. So this shows one of the barriers that the investors might be thinking of and might have them in the back of their mind, and is something that's kind of important to address with clients or with other investors. And then if we drill down, we talk a lot about ESG, but what part of that are investors really focusing on? And it's probably no surprise that environmental is the biggest aspect of that. And I think that's because it's easier to pinpoint, it's much easier to look at the environmental impacts a company has and the measures they put in place to mitigate that. But it's also a bit more prevalent in our everyday lives, people thinking about the environment, switching to greener transport modes, not using single-use plastic, things like that. Whereas if we look at this research in terms of what aspect of that is ESG matters more, the corporate governance and the societal impact is a bit lower down the priorities. And I think it's a little bit harder to gauge, it's a little bit harder to put your finger on or sum up in one word what amazing corporate governance practices is, or what the societal impact of a company is for the average investor. And so that means that increasingly we'll be focusing on those environmental areas as investors, and maybe the other factors will come a bit later. So if we look at investment association data, which gathers all of the data of flows and assets into funds, we can look at that pickup in assets in ethical funds. Now, partly this looks at flows, obviously, but it also takes into account performance. And so decent performance over recent years that we'll look at later will partly account for this rise in assets. But I think what we can also see is that there's a real trend with people investing more money into ethical funds. We've seen this from some of the big corporations. We've seen big pension funds decide to divest from oil companies, for example, or tobacco companies, and that's helping to kind of lead other investors. So if we look at the assets in April, which is the latest data available, it's now almost double where it was at the same time last year, which is a massive pickup in assets. And what we have seen over the pandemic and over the past year is more younger people getting involved in investing. Now it's unlikely that they're coming with massive portfolios, but what that does mean is that each additional pound that they're investing and that they're investing ethically helps to stack up and really boosts this number. And so what we see here is the sales of ethical funds, looking at that. So this data doesn't quite have last year's full year data in, but you can already see that it was on track to be a record-breaking year in terms of the sales of ethical funds. So we were looking at almost 4 billion at that point, and it would have likely have gone past that. It's worth pointing out here that this big leap in 2019 is to do with the way the Investment Association classified their ethical funds, so that accounts for that largely, but that doesn't negate that the upward trend in flows and assets during that time. So what we would expect is, barring any other life-changing events like we've seen recently, that 2021 will continue to see this trend, and we will continue to see that upward tick in terms of retail sales of ethical funds. And obviously hand in hand comes fund launches. So where there's demand, fund companies will launch funds to meet that demand. And what we saw in 2019 was there was this big spike in launches of ethical funds. 2020, that figure is lower. It's likely that it'll be a little bit higher than this once we've counted everything in the year, but it is a bit lower, and that likely just reflects the difficulties of launching funds during COVID. Obviously, investment companies had lots of other focuses during that time, and it was a very tricky year for markets, a very volatile time. So it wasn't the ideal time to be launching funds, and like I say, resources were likely focused elsewhere. So I would imagine, sitting here in a year's time, what we would see is that 2021 would see more like the 2019 figures in terms of fund launches. And what we'll see is when these fund launches come through the system, once you've had 3 years of growth and investment performance, at that point we'll start to see another pickup in adoption, because usually that 3-year track record mark is mostly what investors and advisors are looking for. And so once we've seen that come through the system, we'll likely see another push in assets. And just to highlight that the 2012 spike there is likely linked to RDR and kind of reclassification of share classes, rather than a big spike in actual ethical fund launches. And one of the things I think it's encouraging that more fund groups are launching products to meet investor demand. But one thing I think we have to be cautious about is that where there's a trend, there is always people that want to jump on the bandwagon. And so what this pickup in the number of funds means is that it's harder to do research, it's harder to differentiate between the funds, and it's harder to determine what's taking a true ethical stance and really screening out those companies and really putting a lot of research and resources behind that process, and which are funds that are perhaps just stuck an ethical badge on it, tweaked a couple of things and are aiming to kind of grab some of those assets. So while it's good there's more product launching, it does mean that we need to be a bit more vigilant in terms of really delving into the fact sheets and the information of how those products are put together and how vigorous the ethical research is. So I said that we would talk about performance, and what we can see is, so I just took the Investment Association UK All Companies sector, so just a broad UK equity sector, and the average UK ethical fund has outperformed the average non-ethical fund. And if we look at ethical funds and where they kind of sit in the ranking of that entire sector, over half of ethical funds sit in the top quartile. And what we can see from the table there is that the average ethical fund has outperformed the broader market, and then the FTSE for Good UK, which is the index that tracks ethical investing as well. So we can see that they've had really strong performance. And if we look at the top 10 performing funds in the UK over the past 10 years, half of them are ethical funds, which is pretty amazing when you think about the proportion of ethical funds that will sit in that sector. It's certainly not 50-50 ethical and non-ethical. But while that is great for these ethical managers, there's it's part luck and part judgment, because the markets have really favoured ethical funds over the past few years. So if we delve into how ethical funds are invested, generally they will have a much higher exposure to small and medium cap companies. This is largely because they're shunning some of the large companies. So if we think about the big oil companies and some of the big tobacco companies, they're the massive companies that sit at the top of the market cap spectrum, and lots of ethical funds will have shunned those. And over the recent history, small and medium caps have done better. So that means that you can't categorically just say that ethical funds will always outperform. It's partly the market circumstances of recent years that show that small and medium caps have outperformed in that time. So if we look at the top 5 ethical funds, they only have just under a third of their funds in large caps, whereas if you compare that to the FTSE All Share, 2/3 are in large caps. And if you track across, it's really obvious in the small cap area, so more than a third of those ethical funds are invested in small companies, compared to just over 10% of the FTSE All Share. However, there is obviously evidence that shows that over a long period of time, small and medium caps do outperform, so that could be a trend that continues. But it's not purely the ethical stance that is driving those returns, because if we also look at the top performers in the UK sector, there's a lot of medium and small cap funds in there, non-ethical funds that are featuring at the top there. And so we talked earlier a bit about fund companies generating new funds to meet demand and the processes that they put in place. And there's not one size fits all. If you're an advisor working with clients, or if you're an investor yourself, you'll likely have a different definition of what's ethical behaviour and what's an ethical company to someone sitting next to you. So in your own personal life, you may feel like using the bus a bit more often and not using single-use plastic so much is sufficient, whereas someone sitting next to you may never take a flight and purely vegan and they may feel that that's what's sufficient to live ethically. And so if you look at that dispersion of views, that also translates to investing. So some people will have a very hardline view in terms of the companies they're willing to invest in and the ones that they want to avoid, and others will have a much more softer view and will be happy if they're just investing a little bit better ethically. And the other stance is whether it's better to invest in a so-called bad company and try and lobby for change by being part of that company, or whether you shun that company altogether. So some fund groups and investors will say, it's much better to have a seat at the table. So to invest a smaller amount than the market, but still invest in, for example, a large oil company, but to vote for change internally, and so go to AGMs, ask the difficult questions, push an agenda to make that company more environmentally friendly, and in turn they believe that that will deliver higher profits and better returns for that company. Other people say that either they don't believe that can be effective, or that's not the stance they want to take, and they will only invest in so-called good companies. So they would never invest in those kind of oil giants or tobacco companies, and instead they just want to invest in companies that are openly doing good things environmentally and socially. And I think COVID is a good example of how we're seeing that, particularly the kind of governance and societal impact come to the fore a bit more. So there was a lot of focus on how companies were reacting to the crisis early on. So this time last year, there was a lot of focus on not only how companies were treating staff, but whether they were making use of furlough schemes and government assistance programs, even if they didn't need to, whether they were retaining staff, how they were treating customers as well, and whether they were treating customers sympathetically and, for example, offering refunds, or whether they were being particularly hard. And then on the other end of the spectrum, things like companies that couldn't manufacture things, but instead switched to making hand sanitizer or making face masks or making PPE to help out the NHS and the emergency services, or whether they were donating to food banks. And so what I think we saw in a very short space of time was a very easy barometer for how we judge companies and how focused they were on governance and on benefiting society, or whether they were just out for themselves and for profit. And I think that that really put to the forefront of investors' minds the importance of investing and supporting in companies that have more of a broader focus, have more of a societal focus, and perhaps withdrawing that investment from companies that weren't so good. So I think at the time, Wetherspoons became a bit of a poster child for how not to do it in terms of laying off staff, claiming government furlough money. And so I think both investors will remember that, but also customers will likely remember that. And so that ultimately has an impact on the bottom line. And as an investor, that's also what you're focused on. So I thought it would be good to look at how Agmel as a company is responding to this. So we acknowledge that investors and advisors want more information on ethical funds, and that it isn't always easy to find that information. So we've added ethical funds to our favourite funds list to acknowledge that customer demands, and that means that in a number of sectors you will now be offered an ethical and a non-ethical option. You can weigh them up against each other. So the list of the funds is there that we added to the list, and we already had one existing fund on the list. But we also launched a new fund, and we launched the Responsible Growth Fund, which launched last year, and that screens out sectors and industries that don't fit with ESG guidelines. It uses ETFs for exposure in order to keep costs low, so it's largely tracking MSCI SRI index, so many acronyms, but the index that tracks kind of ethical companies and ESG focused companies. And so around 90% of that fund is in shares, with some allocated to bonds and alternatives, but that's invested across the globe, so it has a global focus. And there's more information about that on the website that you can find. And then the other thing that we launched is a responsible MPS service. So this runs very similarly to our existing MPS service. It's 6 risk managed portfolios allocated to different risk profiles. 25% of each fund is invested in the Responsible Growth Fund that I just talked about, and that's where the investment team can get a bit more tactical exposure, and then the rest of those portfolios are made up with ETFs that track that MSCI SRI index where possible, and it's multi-asset portfolio. So as you look across the risk spectrum, obviously it's investing in an increasing allocation to stocks, and all of the OCFs and the AMC and the underlying costs are under 0.5%. And there's again more information on that. But I thought it was interesting, the investment team put together some information on how that actually stacks up, because I think we often talk about ethical investing, we look at some of the returns and the assets. Actually, it's really interesting to look at the impact investing ethically can have. And so they crunched all of the numbers, so credit to them for this rather than me. But they looked and said that if you invest in the responsible MPS, comparing the balanced portfolio with the just traditional MPS service, so the kind of non-ethical MPS, the carbon impact of it is 77% lower in comparison. And so if you look at that in kind of a real world example, if you invest £20,000 into the responsible MPS rather than the traditional MPS, then that is equivalent to a high meat eating couple going vegan. And then also if we look at £30,000 investment, then that's equivalent to taking a car off the road that runs about 11,000 miles a year. So for some people, that would be their entire car usage in a year. So that has an equivalent carbon impact. And I think those real world examples are a really good way of highlighting how investing ethically isn't just this kind of thing that you see out there that you think, oh, that would be good to do. It actually has a real world impact, and it has a real impact in terms of on the environment and how you're living ethically. So thank you very much. As I said, there's lots more information on the website on those fund launches and on the favourite funds list, and some of the research as well that we've done. So thanks a lot.